If you are using the MACD indicator like everyone else, you shouldn't expect to succeed in trading. You should use it in a unique way in order to have an edge over the other market players. Watch this video until the very end to learn strategies that will help you use this 50-year-old tool in a fresh new way. If you are new to my channel, welcome. My name is Bobby B and I've been trading crypto for a living for a very long time already. I'm currently trading on my personal 6 figures account, and on this channel I'm sharing with you guys everything that I'm learning along the way. Okay, if you've never seen the MACD indicator before, here is everything that you should know. The blue line is the actual MACD and the orange line is the signal line. When the blue line crosses above the orange line, this signals an uptrend. When the blue line crosses below the orange line, this signals a downtrend. The histogram is used to identify the strength of the momentum. It measures the difference between the MACD line and the signal line. The color of the bars shows the trend. When the bars are green, it means that the asset is in an uptrend. When the bars are red, it means that the asset is in a downtrend. The dark bars show an increase in momentum and the light bars show a decrease in momentum. Now let's jump straight into the first strategy that I'm gonna teach you today, and I call this the bull and bear strategy. I'm gonna give you a step-by-step process how this strategy works in order to make sure that you get it. So step number one, add a horizontal line at the zero level. This line separates the bull control zone from the bear control zone. You have to remember that above zero is a bull control zone, which means that the buyers are in control, and below zero is a bear control zone, which means that the sellers are in control. Step number two, while the MACD is in the bull control zone, you trade only bull crosses, and by bull crosses I mean when the MACD line, the blue line, is crossing above the orange line. This is a bull cross, this is a bear cross. So this right here is a bear cross. Do you trade this cross, yes or no? No, you don't. This right here is a bull cross. The MACD line crosses above the orange line. Do you trade this cross while we are in the bull control zone, yes or no? Absolutely. This is a bear cross. Do you take this cross? No, not at all. Then a bull cross. Do you trade this bull cross? Absolutely, because we're in the bull control zone. Bear crosses in the bull control zone we ignore. That's how it works. While the MACD is in the bear control zone, you only trade bear crosses. So do we take this cross, yes or no? This is a bull cross in the bear control zone. Not at all, we ignore it. Do we take this cross, yes or no? This is a bear cross in the bear control zone, so we absolutely take this trade. This is a bull cross in the bear control zone, we ignore it. Bear cross in the bear control zone, that's what we want. And bull cross in the bear control zone, we ignore. Okay, Bobby, but why do we do that? Well, let me ask you this. When you go to your friend's house, who's more confident there, you or him? What about when your friend comes to your house? Now who's more confident, you or him? We are more confident on our territory and less confident on someone else's territory, and the strategy is based on that fact. When the MACD is on the seller's territory, on the bear's territory, you have higher chances of making money if you take bear crosses only. Step number 3 is to place your stop loss under the last swing low for long trades and above the last swing high for short trades, and I'm gonna show you now what I mean by that. So we have here a bull cross in the bull control zone. So do we take this trade? Absolutely. Right after we get the cross, we buy, and now the question is, where are we gonna place the stop loss? Well, we place the stop loss below the last swing low, which in this case it's right here. Now let me give you an example for a short. So we have here a bear cross in the bear control zone, which is exactly what we want. Right after we get the cross, we enter a short trade, and where do we place the stop loss? Well, above the last swing high, which in this case is right here. And after you do that, we go to step number 4, exit longs on bear divergence or change in market structure, and exit shorts on bull divergence or change in market structure. In case you don't have a clue what a bear divergence is or bull divergence, let me show you now. Bear divergence is when you get a high on price and then you get a higher high, while on the MACD you get a high and then you get a lower high. And you will often see this on the histogram as well. So you have a high on the histogram and you have a lower high. And what this tells us is that there is a change in the market, right? Something is off. Usually in an uptrend, you want the MACD to be making higher highs just like the price, and the momentum to be increasing, not to be decreasing. You don't want to see momentum slowing down while price is increasing. When you see this type of thing, you can expect a reversal or at least a pullback. Now, what is a bullish divergence? Well, bullish divergence is the opposite. When you get a low on price and then you get a lower low, while on the MACD you get a low and then you get a higher low. And you will often see this on the histogram as well. You see we have here a low, and then we have a slightly higher low. Well, this tells us the same thing. Something in the market changed, the sellers are losing momentum, and this thing is either going to completely reverse or at least we're gonna get some pullback. So if you are in a short and you see a bullish divergence, it's good to take profits, and if you are in a long trade and you see a bearish divergence, that's the exit. However, in many cases you're not gonna get a divergence, and that's why you're gonna have to exit on market structure. And in case you don't have a clue what market structure is, let me quickly illustrate it for you. So bullish market structure is this: you get a high, get a low, you get a higher high, you get a higher low, you get a higher high, right? So you have a high, higher high, higher high, low, higher low. This is an uptrend. During such a market structure, you wanna hold your long trade. You don't wanna sell. However, if you see this, you get a low here, which is a higher low. Now price fails to make a higher high here and actually makes a potential lower high. You want to be on the lookout. And now if price starts going down here, you wanna place orders to sell your long in case price breaks below this low, because if price goes down and then continue to go up, that's totally fine, right? You're not gonna be stopped out, you continue to ride this trend and everything is fine. However, if price goes down and breaks below this low right here, then this is a change in market structure and you wanna exit your long trade, because this thing now is very likely to continue going down. Okay, that's for the long trades. What about the short trades? Well, for short trades it's the opposite. That's how downtrend looks like. You have a low, you have a high, you have a lower low, you have a lower high, you have a lower low. Okay, so now price starts going up here, everything is totally fine. Then it goes down in an attempt to make a lower low, but before it does so, it starts going up again. Okay, in this case you are on the lookout. You're gonna place an order to exit your short above this high right here, because if price breaks above it, this is change in market structure and you don't wanna be short. Now what might happen in this example is that the price might go down here and continue the downtrend. That's totally fine. You're still gonna be in this trade because your order was above this level right here, and you wanna be in this trade because the downtrend continues. However, if price breaks above this high right here, then this is a change in market structure, because now we have a bullish market structure. Remember my structure I just showed you, where you have a high and then a higher high, a low and then a higher low? Well, you don't wanna be short during this. So when you see this, you have to exit your short, just like I showed you, right? You're gonna place your order above the last lower high right here. Alright, now let me give you some more examples because I really want you guys to get this strategy. What do we have here? We have a bull cross in the bull control zone. So what do we do? Well, we buy. Where do we place the stop loss? Below the last swing low. So in this case, we place it right here. What do we do now? Well, we just sit on our hands and watch what happens. So price starts going up, then it consolidates. Do we have some reasons here to exit, guys? Do we have? Well, no, the market structure is still bullish. There is no divergence, so we just sit on our hand. Now price makes a higher high here. We have some very nice profits. Do we have reason to exit this trade? Well, not at the moment, right? The market structure is bullish. There is no divergence in the MACD. We just sit on our hand. Okay, but what about here? Well, right here we have to be on the lookout. I already showed you the market structure, so you see here that we have a higher low, but then we also have a potential lower high. So in this case, what we're gonna do is that we're gonna move our take profit below this level in order to make sure that if the market structure changes, we're gonna get stopped out. There is no reason to exit the trade yet, right? Because there is no divergence and there is no change in market structure, but you have to be protected and to secure your profits, and you do that by placing your order to exit your trade if we break below this level. After you do that, you just have to sit on your hands again and wait. And what happens here is that the market structure continue intact, price makes a higher high, and you have even more profit. Now I want you to look at the MACD and to tell me, are there some reasons for concern here? Absolutely. What's the reason? Well, the reason is a bearish divergence in the MACD. So you see price made a high and then a higher high, while the MACD made a high and then a lower high. This is not yet confirmed on the MACD itself, but on the histogram it is. So what you can do in this case is to exit your trade when you see the momentum slowing down. You see this first bar right here that is lighter green, right? You remember that in the very beginning I told you that the dark bars show increase in momentum and the light green bars shows a decrease in momentum. So if you want to play it aggressively, you will exit your trade right after when you see this. If you want to play more conservatively, well, you can wait for the divergence to be confirmed on the MACD itself, which happened right here. This gives you a little bit lower exit than the first one, but I know that some of you are conservative traders and prefer to wait. Regardless of which way you take, you still gonna exit this trade, and that's the right decision because after that we got a dump. Now let me give you another example. So we have here a bear cross in the bear control zone. So what do? Well, we sell short. Where do we place our stop loss? Well, we place it above the last swing low here. Now we just have to sit on our hands and look what happened. Price goes down. Are there some reasons for concern here, guys? Well, not really. The market structure is bearish. The momentum is intact. No reasons for concern. What about here? Are there some reasons for concern? Well, the market structure is bearish. There are no divergences. Everything is perfect. What about here? Again, nothing to worry about. We just wait. Alright, but now this happens and this gives us some reasons for concern. So now we're gonna be on the lookout to see what happens. If price breaks above this level, we wanna be out. So before this happens, you have to place your orders above this level in order to be protected. If price continues to go down, that's totally fine. You're still gonna be in the trade, so you're gonna make even more money. However, you want to secure your profits because what also might happen is that the price might break above this level and the market structure might change. So you place your take profit right here, and in this case it was a good decision because price actually broke above this level, and this now is a bullish market structure. You don't want to be holding any shorts during this, so you take your profit and you run. Now I want to show you something that is somehow kept hidden from the masses. Most people know about regular divergences and I just showed you the regular divergences, but very few people know about the hidden ones. And let me tell you something, the hidden divergences are much more powerful than the regular one. So what is the hidden divergence? Well, hidden divergence is when in an uptrend you get a low, then you get a higher low, while on the MACD you get a low and you get a lower low. And you can often see this on the histogram as well. You have a low here and you have a lower low. This is a hidden bullish divergence, and hidden bullish divergences occur during an uptrend and signal trend continuation. The most important part, which can make you a lot of money, is that a regular bearish divergence followed by hidden bullish divergence gets invalidated. Now, the one of you who are sharp, you probably already noticed that there is a regular bearish divergence right here. So we have a high on price, then we have a higher high, while on the MACD we have a high and then we have a lower high. And the same is on the histogram, we have a high and we have a lower high. Normally when people see regular divergences, they are like, oh, this thing is going to reverse, we are going down to zero, let's short. And since they have no clue about the hidden divergences, they often get wrecked. As I already mentioned, a regular bearish divergence followed by hidden bullish divergence gets invalidated. So in this case we got the hidden bullish right after the regular bearish, and this bearish divergence is invalidated. We are not going down. This hidden bullish signals a trend continuation. This thing is going to the moon, and that's what happened. Now let me show you the opposite scenario where we get a hidden bearish divergence. Hidden bearish divergence is when during a downtrend you get a low, then you get a lower low on price, while on the MACD you get a low and then you get a higher low, and you will often see this on the histogram as well. This is a hidden bearish divergence. The hidden bearish divergence occur during a downtrend and signal trend continuation. Also, the key that can make you a lot of money is that regular bullish divergence followed by hidden bearish gets invalidated. Again, the one of you who are sharp, you guys already noticed that there is a regular bullish divergence. We have a low and we have a lower low, while on the MACD we have a low and then we have a higher low as well as on the histogram. So this is a regular bullish divergence, and when people see this during a downtrend, they are like, oh, this thing is going to reverse, this was the bottom, let's go all in, blah 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 blah. And sometimes this is gonna be the case, right? Sometimes this is gonna be the bottom. However, in the cases when you see a hidden bearish divergence, well, that's not the bottom. That's what people fail to understand. If you see a hidden bearish divergence after the regular bullish, you gotta get out of your long and you gotta short because this thing is going down, and that's exactly what happened. Now Now I want to show you another very powerful technique with the MACD which you can use to predict breakouts and rejections. For this technique we use the histogram only, that's why I hid here the MACD and the signal line. We don't need those, we only need the histogram. And I want you guys to remember that the strong momentum leading into resistance is likely to get rejected, and a slow momentum leading into resistance is likely to break it. By the way, don't get confused that this zone right here is green. You can call it a support, but you can also call it a resistance, because when the price is going down, this will act as a resistance, right? Price is not gonna break below it. So when you are shorting, you can call this a resistance. Now back to the strategy. You guys know that we identify momentum with the histogram. So if you are shorting here and you see that there is a strong momentum leading into the resistance, you gotta get out, because this resistance is not gonna get broken. The same thing is right here. If you are short and you see strong momentum leading into the resistance, you gotta get out, because this thing will bounce. Similar thing is right here. Strong momentum leading into the resistance is likely to get rejected, and that's what happened. And by the way guys, you see that the momentum got slower and slower and slower, but it is still strong. Now let's see the next example. Strong momentum leading into the resistance is likely to get rejected. Bam, it's not gonna break it. Same thing right here. But now guys, look at this. Price goes into the resistance and the momentum is very slow. Actually, right before this breakout, the momentum even turns positive, right? You see that the bars here are green. Well, that's exactly what you want to see in order to anticipate a break of the resistance. Slow momentum, guys, leading into resistance is likely to break, and that's exactly what happened. And this, by the way, is Bitcoin 2018, the $6,000 level that the whole market thought this was the bottom at that time, me as well, and I lost a lot of money. I got wrecked during this because I didn't understand this. That's why I'm sharing it with you guys. Here's another example. Let's run through it. Price going into the resistance, the momentum is extremely high, so what's gonna happen? Rejection. Price going into the resistance, the momentum is still high, what's gonna happen? Rejection. Price goes into the resistance, strong momentum, rejection. Look at these guys. Price goes into the resistance, the momentum is very slow. It's negative at the beginning, then it turns positive. But compare this momentum right here before the breakout to this momentum and to this momentum. You see the difference. And then after the breakout, of course, we got an increase in momentum, but that happened after. And this is again Bitcoin, and this is from 2019 when Bitcoin was consolidating around the $4,000. And at that time, I already knew about this strategy, guys. And let me tell you, I made a lot of money. I held through this. I was long, and I watched on Twitter every single person, every single big account. They were all saying that, oh, Bitcoin is gonna get rejected, we're gonna get a dump. Why they were saying that? Well, because 3 times before that we got a dump when Bitcoin reached this resistance. However, they didn't understand what I'm teaching you guys now, so they all got wrecked and I made a lot of money. So I hope that you really get this, and next time when you see this type of scenario, you can make a lot of money while everyone else loses. Okay, but to understand why this works so well, I want to give you guys an example. Think about an army trying to invade another army's territory, because that's exactly what it is. This is the army of the buyers and they are trying to invade the territory of the sellers. Above this is all territory of the sellers. You see, they always defend it. They defended it here, they defended it here, they defended it here. Okay, but then what separates this example from the previous 3 times? Well, what separates this is the fact that the buyers had a lot of ammunition and they had no ammunition here, no ammunition here, and no ammunition here. What do I mean by that? Well, look at the momentum. The buyers already ran out of bullets, right? They ran out of bullets on their way to the real fight, right? This is where the real fight is, guys. The same thing happened right here and the same thing happened right here. That's why they lost the fight. This is the only time when they had all the ammunition in the world to fight at the point where the real fight began. That's the key here, and that's why this strategy works so well. Now I want to show you something else that can help you. Even if you use another trading strategy that have nothing to do with the MACD, you can still use the MACD to improve your win rate. How? Well, you go to a 4 to 6 times higher time frame to check the trend with the MACD, and you then take trades only in the direction of the trend on the higher time frame. So for example, if you are trading on the 1 hour chart, you go 4 to 6 times higher. So let's say that you go on a 4 hour chart and you check what the trend is by using the MACD. bull cross means an uptrend, bear cross means a downtrend. So in this case, the MACD on the higher time frame was in a bear cross, meaning that it was in a downtrend during this whole time. So if you are trading on the 1 hour chart, during this you are not going to take any longs, right? Because if you ignore the dump right here for a moment, and if you just focus on this part right here, many people will look at this and they will try to long this, and they will get wrecked, regardless of what strategy they are using. However, if you do this and you increase your time frame 4 to 6 times, you're gonna have an edge, right? Because you are not going to look for longs during this whole time. You are going to be looking only for shorts.